What you're about to watch is a fascinating and very revealing conversation with Nvidia CEO Jensen Huang at a time when markets are extremely divided on artificial intelligence spending. On one side, you have investors worried about massive capital expenditures from hyperscalers and whether this AI build-out is sustainable. On the other side, you have the people actually building the infrastructure, arguing that we are only at the beginning of something much bigger than most people realize. In this interview, Jensen lays out why he believes AI represents a once-in-a-generation infrastructure build-out, why demand for compute is not slowing down, and why this shift fundamentally changes how software, computing, and ultimately entire business models work. He also directly addresses investor fears, comparisons to past tech cycles, and the idea that we may be overbuilding. After we watch the clips together, I'm going to come back and break down exactly what Jensen is saying, why it matters for investors, and what the market may still be misunderstanding about this AI cycle. If you get value from this video, like, share your thoughts in the comments, and subscribe to the channel so you don't miss out on the next important analysis update. Now, let's watch the video.
It's an interesting time to have you, obviously, which any time is, but especially given what's been happening within the market. Today looks a lot different than the last couple of days have. The market obviously concerned with what's happening on the spending side of the hyperscalers and this big build out in AI. What's your take from that, the way the market continues to react to this?
Demand is sky high, and there's a fundamental reason for that. We're in the once-in-a-generation infrastructure build-out. This is the largest infrastructure build-out in human history, and there's a fundamental reason for that. Artificial intelligence is going to fundamentally change how we compute everything. Everything from database processing, the way we do search, the way we do recommender systems, the way you shop, the way you watch movies, and of course, these new agentic systems that are being developed and evolved. This last year, we saw an inflection point in AI. AI became super useful. No longer hallucinating, it's generating informed content, it's reasoning, it's thinking, it's doing research, it's able to use tools. All of a sudden, AI over the last couple of years went from being curious to super useful. The inflection point also came with it, profitable tokens. Anthropic is making great money. OpenAI is making great money. If they could have twice as much compute, the revenues would go up 4 times as much. I mean, literally these guys are so compute constrained, and the demand is so incredibly great. The number of enterprise users, the number of consumer users, the number of startups that are being built on top of these companies, it's just going through the roof.
So when you see numbers that are frankly remarkable, that $660 billion this year will be spent by the hyperscalers as we continue to learn, like we did from Amazon last night, you sit back and think to yourself, that's completely justified based on what you see?
It is appropriate and sustainable. And the reason for that is because all of these companies' cash flows are going to start rising. You know, people are comparing it to cash flows. One of those numbers are wrong. It's just the cash flow is wrong. We are addressing the largest software opportunity in history. For the very first time, software is not just a tool. A tool is like Excel. Now software uses tools. So these AIs use Excel. And so I think the opportunity for this new era of software is incredible, and we're seeing it already moving the earnings of Meta. Nobody uses AI better than Meta, and so if you look at the way that they're using AI went from a classical recommender system running on CPUs to now a generative AI agentic system that is making recommendations. Everything from the way social media works and the way they recommend ads and help advertisers create content has fundamentally been changed, and their earnings show it. And that's the reason why they're investing so hard. They see just a much larger future potential for it. And not just one company. This is going to affect AWS's shopping and the way they recommend goods. This is going to affect how Microsoft's enterprise software works. Every single company sees the same inflection point, and that's why everybody's leaning in so hard.
I feel like that's the point that it's an interesting point. It sort of turns the way you need to think about these businesses on its head. That if you're just fixated on the spending side, as you were talking earlier about, oh, they're spending such a huge portion of their free cash flow, you're kind of missing the story. The market needs to get its arms around that. Do you as well as an investor?
Yes. If you turn the clock back, Scott, to 2008, 2009, right, Amazon could have taken their profits and sent them back to us by way of dividends. Instead, Jeff Bezos said, I'm going to invest in this thing called AWS. Think of it as digging a gold mine. You have to spend a lot of money to dig the gold mine before you get the gold out. These guys are digging the biggest gold mine in the history of software, right? But it costs something up front. Now the question is, do you believe Andy Jassy and Mark Zuckerberg and Sundar and Jensen that this opportunity is that big, or do you have a special insight that causes you to understand there's no gold in the bottom of the gold mine? As an investor, I'll just tell you this. I want my personal net worth, I want my fund's net worth levered against AI, because all human progress is going to be derived from machines helping humans think and augment human thinking. And so whether it's owning Nvidia, which is our largest public position, or whether it's Anthropic or OpenAI, all of these companies are going to be tremendous beneficiaries, and they're doing it at scale. There are increasing advantages to scale, right? And so I think it's hard for people to get their arms around now, just like it was in 2008 and 2009. But thank God Jeff Bezos did that. Now it's a $140 billion business, generating $30 billion a year in annual profits that people criticized him for investing in back then.
It's incredible that OpenAI and Anthropic are $20 billion run rate companies, generating profitable revenues and accelerating growth all at the same time.
Right.
These are extraordinary things, and it makes perfect sense from where we sit.
How can we be so certain that the amount of compute we think we'll need, and that we continue to hear from CEOs like you that we will need, is actually going to come to fruition? Isn't it inevitable that we're going to, at some point, overdo it, but we're not going to know that until it's too late?
It's not like roads. Roads, once you lay it down, it stays fairly useful for a long time. The way computers work is you build up the infrastructure, but then you start replacing it 5, 6, 7 years later. And so I think it's going to take us some 7 years, 8 years to build up to the level that we have to sustain. And after that, we're going to be refreshing and slightly growing. And so we've got several years of build out ahead of us. The important thing is this. You have to go back to first principles. Computing has fundamentally changed. It used to be pre-recorded. Excel and PowerPoint and all these tools and all this software is pre-compiled. They compiled it and they send it to us. The way software works now, because it's contextually aware, every single time you use it, it takes into consideration the context, who you are, what you're asking about, what's happening to the world, what other information you give it, the context. And every single context is different, and every single response is different. So from now on, every single pixel, every single beep of a sound, every video that comes out of the computer is generated in real time. And that's the reason why we need computers to operate software at such a large scale going forward. And all these tokens are what we call intelligence. And for the first time, we're generating something of tremendous value, intelligence as numbers. And these things, as I mentioned earlier, this last year, we went through an inflection point because these tokens became profitable. And so we just have to make more of it.
Can you blame, in some ways, investors who have PTSD from the last time tech went through this revolution and evolution at the same time, for seeing certain things that remind them of then and worry that they'll happen again?
It's good to always reflect on history. History informs us, but history doesn't repeat. And so you have to take into consideration what's actually happening. Always go back to first principles and think about what is actually happening. Right now, the fundamental difference, a huge difference between now and some things that happened in the past with the internet, there was a ton of dark fiber. There are no dark GPUs. 100% of the GPUs are rented. In fact, GPUs that we sold 6 years ago, the prices are going up. It's not like it's antique. I mean, it's incredible. It's like a fine wine. The demand is so high that GPUs I sold 6 years ago are going up in price. And so I think the demand is just incredibly high for the reasons that I just said. One, we went through an inflection point. AI has become useful and very, very capable. Two, the adoption of it is incredibly high. And three, because these AIs are thinking, the amount of computation it needs is great. And so to the extent that people continue to pay for the AI with, and the AI companies are able to generate a profit from that, they're going to keep on doubling.
All right, now that we've watched that interview, there is a lot to unpack here, because Jensen Huang wasn't just defending Nvidia or reacting to a volatile market day. What he was really doing was laying out a first principles argument for why artificial intelligence is not just another technology upgrade, but a complete redefinition of how computing works, how software is delivered, and how value is created across the global economy. Let's start with the context, because it matters. The conversation opens in a moment where markets are clearly nervous. We've seen sharp rotations, we've seen concerns about hyperscaler spending, and we've seen headlines questioning whether companies like Amazon, Microsoft, Google, and Meta are spending too aggressively on AI infrastructure. When you hear numbers like $660 billion in annual hyperscaler capital expenditures, it is very easy to anchor on that spending and immediately think something must be wrong. That reaction is human. Investors are conditioned to worry when spending spikes this quickly. Jensen's response to that concern is not emotional and it's not promotional. It's structural. He says demand is sky high, and then he immediately explains why. According to him, we are in the largest infrastructure build-out in human history. That is a bold statement, and if you stop there, it can sound like exaggeration. But what he does next is crucial. He doesn't justify that claim by pointing to hype or speculation. He justifies it by explaining that artificial intelligence fundamentally changes how all computing is done. In the old model of software, most computing was pre-compiled. Someone built Excel, PowerPoint, search algorithms, recommender systems, and then shipped that software to users. The computation happened in predictable, relatively static ways. AI changes that entirely. Now, every interaction is contextual. Every query is different. Every response is generated in real time. Every pixel, every sound, every piece of text is being created on demand, not pulled from a pre-built template. That distinction matters enormously for compute demand. When Jensen says AI will change everything from database processing to search, shopping, entertainment, and enterprise workflows, he's not talking about incremental improvements. He's talking about a shift from static software to living, adaptive systems that reason, plan, research, and use tools dynamically. That kind of system doesn't just run once and sit idle. It consumes compute continuously. One of the most important points he makes is about the inflection point we crossed recently. He argues that over the last year, AI went from being interesting and sometimes unreliable to being genuinely useful. It stopped hallucinating as much. It started reasoning better. It became capable of doing real research, using tools, and generating informed content. That's when everything changed. When technology becomes useful at scale, adoption accelerates non-linearly. And here's where he introduces a concept that many investors still underestimate, which is profitable tokens. This is not a buzzword. This is a business model shift. When companies like OpenAI and Anthropic can generate meaningful revenue from AI usage, and when those revenues scale faster than compute costs, you suddenly have an economic flywheel. Jensen makes a striking claim here. He says that if these companies had twice as much compute, their revenues could grow 4 times as much. That tells you 2 things. First, demand is not saturated. Second, compute is the bottleneck, not customers. This directly challenges the narrative that hyperscalers are recklessly overbuilding. If demand is constrained by supply, then spending more to expand supply is rational, not reckless. And when Jensen talks about the explosion in enterprise users, consumer users, and startups building on top of these AI platforms, he's describing a layered ecosystem. Nvidia sells the infrastructure. Hyperscalers deploy it. AI labs build models. Startups build applications. Enterprises integrate them into workflows. Consumers use them daily. Each layer amplifies demand for the layers below it. When the interviewer brings up the $660 billion spending figure and asks whether it's justified, Jensen doesn't hesitate. He says it's appropriate and sustainable. That word sustainable is doing a lot of work here. He argues that the reason it's sustainable is because cash flows are going to rise across these companies. In other words, this isn't spending for spending's sake. It's spending to unlock future earnings power. This is where Jensen reframes the entire conversation. He says people are comparing spending to cash flows, but one of those numbers is wrong. According to him, the cash flows are wrong because they don't yet reflect the scale of the opportunity. He calls this the largest software opportunity in history. And again, that sounds dramatic until you understand what he means by software no longer being a static tool. Software now uses tools. AI agents can operate Excel, search the web, analyze data, write code, design content, and make decisions. That shift means software is no longer a productivity enhancer, it's becoming a cognitive partner. And when software can think, reason, and act, its economic value increases dramatically. Jensen points to Meta as a real-world example. He says nobody uses AI better than Meta, and that's a strong statement considering the competition. Meta transformed its classical recommender systems running on CPUs into generative, agentic AI systems. These systems don't just recommend content, they generate content, optimize ad creation, personalize feeds in real time, and help advertisers achieve better outcomes. The key here is that Meta's earnings reflect this shift. AI is not a science experiment for them. It is directly improving monetization. That's why Meta is investing so aggressively. And Jensen is clear that this is not unique to one company. Amazon will use AI to transform shopping and recommendations. Microsoft will embed it deeply into enterprise software. Google is doing the same across search, advertising, and productivity. Every major platform sees the same inflection point, and that's why everyone is leaning in at the same time. This leads into one of the most important investor psychology points in the entire interview. The interviewer notes that if you fixate only on spending, you miss the story. And Jensen agrees. He compares the current moment to 2008 and 2009, when Amazon could have returned profits to shareholders but instead chose to invest heavily in AWS. At the time, many investors criticized that decision. It looked risky, it looked expensive, it looked unnecessary. But Jeff Bezos understood that AWS was a gold mine. You had to spend a lot of money up front to dig it, but once the infrastructure was built, the returns would be enormous. Today, AWS is a massive profit engine. Jensen argues that AI infrastructure is an even bigger gold mine. The cost to build it is high, but the long-term payoff could dwarf previous software cycles. He frames the investor decision very simply. Either you believe leaders like Andy Jassy, Mark Zuckerberg, Sundar Pichai, and Jensen himself understand the size of this opportunity, or you believe you have special insight that tells you there is no gold at the bottom of this mine. That's a powerful way to think about it. Because these are not inexperienced executives chasing hype. These are operators who have successfully navigated multiple technology cycles. Jensen then makes his own position very clear. He wants his personal net worth and his funds leveraged to AI. Why? Because he believes all human progress going forward will be derived from machines helping humans think and augment human intelligence. That is not a short-term trade thesis. That is a civilizational thesis, and it explains why Nvidia is his largest public position. He also touches on scale, which is another concept that investors often misunderstand. AI has increasing returns to scale. The more data you have, the better your models. The more compute you have, the more capable your systems. The more users you have, the more feedback loops you create. That makes it harder for smaller players to compete and strengthens the position of leaders. When the interviewer mentions how incredible it is that OpenAI and Anthropic are already massive, profitable, fast-growing businesses, Jensen treats that as confirmation, not surprise. These companies are generating enormous value, and they are doing it at scale. That matters, because profitability at this stage of a technology cycle is rare. It suggests real demand, not speculative usage. Then comes the question many investors are silently asking. How can we be sure we won't overdo it? Isn't it inevitable that we build too much compute before we realize demand has peaked? Jensen's answer here is subtle and important. He says computing infrastructure is not like roads. Roads last for decades with minimal change. Computing infrastructure is constantly refreshed. GPUs get replaced every 5 to 7 years. Performance improvements drive new use cases, which drive more demand. He believes it will take 7 or 8 years just to build up to the level of infrastructure needed to sustain this new computing paradigm. After that, the industry will move into a cycle of refreshing and gradual growth. In other words, even if growth slows, replacement demand remains. This is not a one-time build. Then he goes back to first principles again. Computing has fundamentally changed. Software is no longer pre-compiled. It is contextually aware. Every interaction is unique. That means every output must be generated in real time. That's why compute demand explodes. Every token generated by an AI model represents intelligence created as numbers. For the first time, intelligence itself is being produced, measured, and monetized at scale. And critically, those tokens became profitable. That's the inflection point Jensen keeps returning to. Once intelligence generation becomes profitable, the incentive to produce more of it is overwhelming. That's why demand keeps rising. Finally, the interviewer asks about investor PTSD from past tech bubbles. Jensen acknowledges that history matters, but he says history doesn't repeat. You have to analyze what's actually happening now. During the internet bubble, there was massive unused capacity. Dark fiber everywhere. Today, there are no dark GPUs. Every GPU is rented. Even GPUs sold 6 years ago are increasing in price. That alone tells you supply is tight. That comparison is devastating to the bubble narrative. In bubbles, assets depreciate quickly because supply exceeds demand. Here, older assets are appreciating because demand exceeds supply. That's not speculative excess. That's structural scarcity. Jensen concludes by tying it all together. AI has become useful. Adoption is massive. These systems think, and thinking requires computation. Put those three together, and the demand picture becomes very clear. From an investor perspective, this interview is not about predicting next quarter's earnings. It's about understanding a paradigm shift. If Jensen is even partially right, then AI infrastructure is not a short-term spending cycle. It is the foundation of the next era of software, productivity, and economic growth. And that's why markets may continue to underestimate what's happening here, just like they underestimated AWS 15 years ago. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.